Welcome to the Deep Dive. This is where we dig into the details, especially for you, the individual investor, trying to make sense of complex company reports. Today we're tackling Kuzey. We've got their 9-month 2025 activity report and the financial statements right here, and we're going deep.
And this one's definitely a complex mission. It's not just straightforward numbers we're looking at. We're dealing with the results that have been restated using Turkey's high inflation accounting standard, TMS 29. Right, TMS 29. That means pretty much everything, revenue, profits, assets, it's all adjusted to reflect current purchasing power, doesn't it?
Exactly. So our job today is really to cut through that noise, the noise from inflation, and figure out what's real operational health. How much is the actual business performance versus maybe some, let's say, financial engineering effects from the accounting standard itself. We need to spot the real growth drivers, but also the immediate risks.
Precisely. Filtering the financials, looking at the strategy behind them. Okay, let's start with the foundation then, part one. For anyone maybe not following Kuzey day to day, what's their core business? What are they actually making and selling?
Okay, so Kuzey is a pretty significant manufacturer in the world of plastic and composite pipes. They make a really wide range. You've got your standard HDPE pipes, high-density polyethylene, corrugated pipes often used for sewage. But they also do more specialized stuff like GRP, that's glass fiber reinforced polyester composite pipes, and PPR pipes, polypropylene random copolymer.
Okay, so PPR, that sounds like the stuff maybe used inside buildings for plumbing hot and cold water.
Yeah, exactly. Think bathroom taps, heating systems, that's superstructure.
And the bigger diameter HDPE and GRP pipes, those are more for the big infrastructure projects, right? Like municipal water mains, sewage networks.
Precisely. They're fundamentally infrastructure builders. Their products are essential for, well, almost any major construction project, whether it's a new high-rise building or those huge hidden networks carrying water, gas, sewage that, make a city function. And they market everything under one brand, Kuzey, which seems to have built up some solid recognition, both here and internationally.
Sounds like a serious operation.
Yeah.
What about their physical size? Their footprint? Where are they based? How big are we talking?
The scale is definitely large. They operate across roughly 200,000 square meters in total area. Their main hub, the operational center, is in Aksaray, right in central Anatolia. It's where you'll find the headquarters. 2 main production sites, a sub-branch in the Tenta Park there, and also their dedicated R&D center.
Aksaray is the core then, but they have other locations.
Yes, they've got other domestic branches spread out strategically, places like Balıkesir, Malatya, Ankara, and Istanbul. It helps them cover the country for, say, big national tenders and projects.
And what about international reach? Are they just exporting, or do they have people on the ground elsewhere?
They're definitely aiming for a global presence. While the manufacturing is based in Turkey, they have sales representatives set up in key international hubs. We're talking Dubai, Italy, and Qatar. That's their sort of front line for trying to capture those export sales, which, as we'll see later, is actually a really sensitive area in their recent performance.
Okay. And before we jump into the financials, quality must be a big deal in this sector, right? Especially for infrastructure. Certifications and things?
Oh, absolutely critical. You can't play in the big leagues, especially with government contracts, without them. They list a whole string of certifications: ISO 9001 for quality management, 14001 for environmental standards, 45001 for occupational health and safety. It signals they meet those top-tier requirements.
And the report flagged something specific, a big strategic win considering their GRP pipes from the Malatya plant. What was that about?
Yes, that's potentially a game changer for them. Their GRP pipes made in Malatya got the official stamp of approval from DİSAI. DİSAI is the State Hydraulic Works, basically the main government body in Turkey dealing with water infrastructure projects.
So this isn't just a quality certificate, it's like a golden ticket.
Pretty much. Getting DS approval means Kuzey can now bid directly on all major DSS tenders. That opens up a huge, potentially very reliable stream of domestic, state-funded projects, specifically for their GRP products, which tend to be, higher margin composites. It definitely boosts their competitive position within Turkey.
Okay, good context. Let's widen the lens a bit now. Section 1.2, the sector and competition. Is this a growing market they're in?
Generally, yes. The overall macro picture looks supportive for their long-term plans. The global market for plastic pipes is expected to grow somewhere in the range of, say, 4 to 6% annually. Pretty healthy.
And what about the composite side, the GRP?
That's where the growth looks even more promising, actually. The global GRP market, which is, like you said, the more advanced, higher value end, is projected to hit around 7.7 billion US dollars by 2027. That's growing at a compound annual growth rate, a CAGR of about 5.5%.
And what's driving that growth globally?
It's a combination of things. You've got older infrastructure in developed countries needing replacement, think water and sewage systems, plus rapid urbanization, especially in developing regions like Asia-Pacific, the Middle East, and Africa, means huge demand for new infrastructure. Kuzey seems positioned to tap into that.
So the global tide is generally rising. How do they stack up within Turkey itself? Are they a big fish in that pond?
Domestically, especially regionally, they are quite dominant. The report identifies them as one of the largest producers in the Central Anatolia region specifically, with a capacity around 223,000 tons. However, the Turkish market itself seems pretty fragmented. TOBB, the Union of Chambers and Commodity Exchanges, apparently lists about 189 firms making similar types of rigid plastic pipes.
So lots of competitors, but maybe smaller ones.
Likely many smaller regional players. Kuzey scale, and importantly, that DSU approval we just talked about probably gives them significant advantages over the smaller competitors, particularly for large projects.
Interesting. I also saw a note in the report about their community involvement, something beyond just pipes.
Yeah, they seem to be doing some work on their corporate image and brand awareness. They're the main sponsor for the Kuzey women's volleyball team. Apparently, the team competes in the Sultanlar Ligi, which is the top women's volleyball league in Turkey. That's pretty high visibility branding.
Volleyball sponsor, okay. Anything else?
They also do these recurring pasta bridge competitions. Seems like something aimed at university engineering students, getting them involved. It's kind of a clever way to connect the brand with future engineers, the very people they might want to hire or sell to down the line.
Smart. Targets the public and the future workforce. All right, let's quickly touch on the corporate structure, 1.3. There was a huge change in their capital structure recently.
Huge is right. Back in May 2025, they did a massive mover. They increased their paid-in capital by 500%, taking it up to 600 million Turkish lira. But the key point here is how they did it. It was entirely funded from internal sources, a bonus issue. They used retained earnings, reserves, share premiums, things like that. No new cash came in from shareholders for this.
Wow, a 500% increase just from internal funds? That signals they had significant reserves built up. But multiplying the share count by 5, that definitely impacts things like earnings per share, right? Even if profits stay the same, the per share number drops massively.
Exactly. It dilutes the EPS figure instantly. Now, looking at who actually controls the company, the founding families are still very much in charge. The main shareholders are Mustafa Topgas with 30%, Bülent Karaman also with 30%, and Demet Karaman holding 15%. That adds up to 75%.
So the remaining 24% is the public float, the shares traded on the market.
Correct. Those are the Group B shares. But here's a critical detail for you as an investor. The voting rights are different. The Group A shares, held by those main partners, get 5 votes per share. The Group B shares, the ones available to the public, only get 1 vote per share.
5 votes versus 1. So even with 75% of the capital, their voting control is much, much higher than that.
Yeah.
Effectively absolute control. Public shareholders have very little say in decisions.
That's the reality, yes. Control is very tightly held. Now, moving to people. The workforce saw a massive expansion. Employee numbers basically doubled, a 100% increase just since the end of 2024. They reached 675 staff members by the end of this 9-month period.
Doubled the workforce. That must mean.
Yeah, mostly blue-collar production workers, 540 of them. And 135 white-collar staff, admin, technical, R&D, etc. This huge hiring jump directly reflects the startup and ramp-up needs for all the new production capacity and investments we're about to discuss. It's not cheap to double your staff in 9 months.
No kidding. What about pay at the top? Did they disclose board and management compensation?
They did. For the 9-month period, the total pay for the board of directors and top management came out to 8,240,106 TL. That's disclosed as part of their governance recording.
Okay. And speaking of the board and governance, what's the diversity picture like?
The board has 7 members in total. One of those members is female, Demet Karaman, who is actually one of the major shareholders and also serves as vice chairman. So that's 1 out of 7, about 14% female representation on the board.
Right. And you mentioned governance. Any specific structures in place? Committees?
Yes, they seem to be following the higher tier requirements. They operate as what's called a first group company in terms of governance standards. They have these standard required committees, an audit committee, a corporate governance committee, and interestingly, they set up a dedicated risk early detection committee in April 2024. That suggests a more formal, proactive approach to managing potential risks.
Okay, established company, complex structure, tightly controlled, investing heavily. Let's unpack that investment piece now in part 2. Strategic investments and R&D focus. They're clearly not just maintaining the status quo. They're placing some big bets on the future. This seems to be the core of the positive story, the bullish case for the company.
Absolutely. This is where you really see the ambition and also where the borrowing starts to ramp up significantly. The report shows substantial investment spending CapEx hitting 401.8 million TL just in these 9 months, covering tangible assets like machinery and buildings, plus intangible assets. That level of spending signals a very aggressive, confident strategy.
Okay, break that down for us. What are the major projects? I saw something about solar energy, GES.
Yes, the GES project, the solar energy plant. This is a really key strategic move. They're aiming to install enough capacity to cover 100% of their electricity needs. The contract value mentioned is 8.7 million US dollars. And they're financing this mainly through a financial lease agreement spread over 60 months, so 5 years.
Covering 100% of their electricity. It's huge.
Right.
Especially with volatile energy prices. It basically takes a major variable cost off the table, right?
Exactly. It dramatically de-risks their operational cost base. Instead of fluctuating energy bills, they'll have a predictable, fixed depreciation cost from the plant over its lifetime. It's a significant potential competitive advantage in the long run.
Makes sense. Okay, what about investments in actual pipe-making capacity? Seems like they're expanding on multiple fronts.
They really are. It's like a three-pronged attack to boost capacity in their most strategic product areas. First, in Malatya, remember where they got that DSE approval for GRP pipes? They're pouring 5.4 million euros into expanding that GRP capacity by a whopping 70%.
70% increase in GRP capacity.
Yeah.
What kind of return are they expecting from that?
The projection they put out is quite staggering, actually. They estimate this single expansion project could generate an additional 40 million US dollars in annual revenue.
$40 million annually from just one site's expansion. That's ambitious. It suggests they're really targeting those high-value, potentially international GRP contracts.
It certainly signals high confidence in their ability to sell that new capacity at good prices. Okay. The second major investment front is in Balıkesir. They're building a completely new thermoplastic plant there, codenamed EGE1. The target is 45,000 tons per year capacity.
A whole new plant. Big cost.
The equipment alone was budgeted at about 5.26 million US dollars. And to help fund this, they secured some significant external financing. Notably, a 7 million US dollar loan specifically for this project from TSKB, the Industrial Development Bank of Turkey, possibly backed by IBRD funds. Getting that kind of long-term loan from an investment bank shows external validation of their strategy, you could say.
Right, suggests the banks believe in the plan too. And a third piece of the expansion puzzle.
That was back in Aksaray, their home base. They completed an expansion of their PPR pipe plant. It was finished and operational by September 2025. This involved a total investment of around 5.33 million US dollars and increased their capacity for PPR pipes by 60%.
So more PPR capacity too. That targets the building and construction market, right?
Yes, the standard, often high-volume domestic and maybe regional superstructure market. So you put these three major projects together, the GRP boost in Malatya, the new thermoplastic plant in Balıkesir, and the PPR expansion in Aksaray. And it starts to explain that 100% jump in workforce we saw earlier.
Yeah.
They're fundamentally scaling up the entire operation, trying to transition from being maybe a regional leader to a truly national player with serious export potential.
That level of investment in physical capacity really needs to be supported by innovation, by R&D, doesn't it? Let's look at Section 2.2. R&D is a strategic priority. Did their spending reflect this ambition?
Oh, absolutely. The commitment to R&D seems to have exploded in this period. R&D expenses leaped up, roughly 5 times higher than the previous year. They spent 24.57 million TL on R&D in these 9 months, compared to just 4.87 million TL in the same period of 2024. That's not just ticking a box. It's a serious allocation of resources toward developing future technology and processes.
24 million TL. What are they actually working on? Any specific projects mentioned?
Yes, they highlighted 2 active projects supported by TÜBİTAK. That's Turkey's main scientific research council. So getting their backing is significant, adds credibility. The first project title is quite interesting. Energy efficiency-focused digitalization systems in extrusion pipelines.
Digitalization. Using AI, maybe?
It sounds like it. They mentioned using AI and advanced sensors to optimize the production lines, aiming specifically at energy efficiency. This ties in perfectly with their big investment in the solar power plant, right? Generate your own cheap power, then use AI to minimize how much power you actually need to make the pipes. That creates a potentially powerful cost advantage.
That's a strong synergy. Own power source plus AI optimization. What was the second Tuba 2 project?
The second one focuses on innovative socket mold systems for corrugated pipe production. This seems to fall under the umbrella of green transformation. The goal is likely sustainability, maybe reducing material waste during production, improving the jointing systems, making the process more efficient and environmentally friendly.
So efficiency and sustainability, is this R&D actually leading to tangible results like patents?
Yes, they specifically mentioned one key output. They've completed the national patent application for something called Palestra. It's described as an innovative composite filler material they've developed in-house.
A new material, what does it do?
Apparently, it's designed to improve things like the surface quality of the final pipe, make the manufacturing process more stable, and crucially, again, enhance energy efficiency during high-volume production. And they're not stopping at a Turkish patent. They said they're already preparing the international patent application through the EPO, the European Patent Office.
Okay, so developing proprietary materials, patenting them internationally, that positions Palestra as a potential strategic asset, something that could differentiate their products, especially for export markets where quality and unique features matter.
Exactly. This R&D spending seems clearly aimed at creating genuine differentiation and maybe intellectual property value, not just meeting basic compliance standards.
Okay, this is where things get really interesting, I think. Part 3, operational and margin performance. We've got this picture of massive investment, aggressive expansion, big R&D push. But how did the actual business perform during these 9 months? And crucially, remembering everything is adjusted for inflation via TMS 29.
Right. This is where we need to walk that analytical tightrope, separating the operational reality from the accounting effects. Let's start with the top line, hasat, or revenue. The headline number here is actually a decrease. Overall sales fell by 15.3% compared to the same period last year.
Down 15.3% after inflation adjustment. That's a pretty significant drop, especially for a company investing so heavily in growth. Where did that weakness come from?
The report gives us a geographic breakdown, and that's really the key insight here. Domestic sales, so sales within Turkey, actually held up quite well. They increased from about 2.54 billion TL last year to 2.82 billion TL this year. So the home market seems robust, maybe helped by that DS approval and ongoing infrastructure project.
Okay, domestic is up, so the drop must have come from...
International sales. Your Deutsche Saatler. They absolutely collapsed. Revenue from exports fell dramatically from 1.87 billion TL in the first 9 months of 2024 down to just 0.95 billion TL in the same period of 2025.
Wow, wait. From 1.87 billion down to 0.95 billion. That's nearly a 50% contraction in their export revenue, in real terms. They're spending millions on new capacity aimed partly at global markets, and yet their existing international sales effectively got cut in half. What does that suggest?
It strongly suggests they face some serious headwinds in their export markets during this period. It could be several things, right? Maybe intense price competition internationally, maybe unfavorable exchange rates, making their Turkish lira-based cost translate into expensive dollar or euro prices abroad. Or perhaps just economic slowdowns in some of their key export destinations, like the Middle East or parts of Europe. But whatever the exact cause, losing almost half your foreign sales volume while you're simultaneously ramping up production capacity creates a major tension in the business model.
A huge disconnect there. Okay, so top-line revenue under pressure due to exports. What about profitability? Did the margins hold up despite the volume drop?
This is where the counter-narrative comes in, the efficiency story. And it's actually quite strong. Their gross profit margin saw a noticeable improvement. It rose from 25.36% last year to 27.19% this year.
Okay, so for every lira of pipe they sold, they kept more as gross profit. How did they manage that with lower volume?
It points towards really good cost control at the production level, maybe better raw material purchasing, perhaps early benefits from energy planning, or just general manufacturing efficiencies kicking in. Their EBITDA margin also held up reasonably well. It slightly improved, actually, from 18.19% to 18.42%.
Interesting. Better gross margin, stable EBITDA margin. Yet you said overall profit suffered. How does that work?
Well, the improved rate of profit couldn't fully offset the sheer drop in total revenue. When we look further down the income statement at İsas Faaliyet Kurum, the operating profit from core business activities, That decreased significantly. It fell to 495.1 million TL, down from 657.1 million TL in the prior year period.
So even though they were making more profit per pipe, selling significantly fewer pipes meant the total operating profit dollars, or lira rather, went down.
Exactly. The volume contraction hit was just too big. Plus, you have to factor in the increased strategic spending we talked about, that five-fold jump in R&D expenses to nearly 25 million TL, plus likely higher selling, general, and administrative SG&A costs needed to support the expanding operations and new facilities. All of that puts additional pressure on the operating profit line.
Right, the cost of growth eating into the profits from existing sales. Okay, this setup leads us perfectly to what seems like the biggest financial paradox in this whole report. Operating profit is down significantly. Financing costs must be way up with all that new debt. Yet somehow their net income actually increased. How on earth did that happen?
This is the absolute core of understanding these financials under TMS 29, and it's driven entirely by something non-operational. You're right, net period income, the bottom line profit, did indeed increase. It went up to 617.01 TL from 541.6 million TL last year. As a result, the net profit margin looks fantastic, jumping from 12.31% to 16.53%. But crucially, this wasn't because they suddenly started selling pipes much more profitably at the net level.
So walk us through it. What's the magic item below the operating profit line that saved the day?
The hero, or perhaps the confusing element, depending on your view, is an item called monetary gain loss, or parasal kazanç kayıp in Turkish. Look at the comparison. In the first 9 months of 2024, they recorded a monetary loss of 208.7 million TL. In the first 9 months of 2025, this completely flipped to a massive monetary gain of 494.3 million TL.
Hold on. A swing from a 200 million loss to a nearly 500 million gain. That's a 700 million TL positive swing from just one line item. What exactly is this monetary gain? Is it real money?
It's real in an economic sense under inflation accounting, but it is absolutely not cash. It's an accounting adjustment required by TMS 29. It arises because Kuzey during this period held more monetary liabilities, like loans, accounts payable, than monetary assets, like cash, receivables.
Right.
They were in a net monetary liability position, or simply put, they were a net debtor.
Okay, they owed more money than was owed to them or held in cash. How does that generate a gain in high inflation?
Think about it. If inflation is very high, the real value, the purchasing power of the money you owe decreases over time. That 600 million TL capital figure we mentioned earlier is now worth less in real terms than it was. The debt they took on last year requires repayment in lira that have lost significant value. TMS 29 mandates that companies calculate this effect. Because the real burden of their existing debt decreased due to inflation eroding the value of the lira, they record this reduction in their debt's real value as a monetary gain.
So essentially, the high inflation is eroding the real value of their debts faster than, say, their cash is losing value. And this accounting gain plugged the hole left by lower operating profit.
It did more than plug the hole. This nearly $500 million lira non-cash gain completely swamped the decrease in operating profit, and importantly, it also offset the dramatic increase in their financing expenses. Remember all that new debt? Their finance costs also exploded, jumping from 143.0 million TL last year to a huge 508.8 million TL this year.
Wow. So the monetary gains single-handedly masked both weaker core operations and the massive cost of servicing their rapidly growing debt pile.
That's the perfect summary. It creates a bottom-line net profit figure that looks healthy, even improved, but the underlying operational health and the cash flow reality are much, much weaker. And it highlights a major risk. If inflation were to suddenly drop significantly, this large monetary gain could shrink rapidly or even flip back to a loss, potentially revealing a very different net income picture without any change in their actual pipe-selling business.
That's a critical point for investors to grasp. Okay, let's shift gears then to part 4 and look directly at the balance sheet and cash flow. What does this aggressive investment and the reliance on monetary gains mean for the company's actual financial health, its debt load, and its ability to generate cash?
The balance sheet tells the story of that investment drive very clearly. Total financial debt has more than doubled. It ballooned from 1.10 billion TL at the end of 2024 to 2.31 billion TL by the end of September 2025. That's a huge jump of about 1.2 billion TL in just 9 months.
And that 1.2 billion increase in debt, that lines up pretty directly with the spending on those big projects. Malatya, Balıkesir, the solar plant.
Exactly. It confirms they financed a large chunk of that aggressive CapEx program through borrowing.
What does that debt look like? Is it mostly Turkish lira debt, or foreign currency? What are the rates?
It's a mix, and the cost difference is stark. The report indicates their Turkish lira-denominated debt carries a pretty painful weighted average interest rate of 27.95%. Very expensive. To manage this, they seem to rely quite heavily on cheaper foreign currency borrowing. Their U.S. dollar debt has an average rate of 8.74%, and the euro debt is even lower at 6.99%.
Okay, so using cheaper dollar and euro loans helps keep the overall interest bill lower than if it were all in lira. But that introduces significant FX risk, right? If the lira weakens further against the dollar or euro.
Precisely. It becomes a double-edged sword. A weaker lira makes their exports potentially more competitive, but it also instantly increases the lira value of their foreign currency debt principal and interest payments. It's a major sensitivity.
I also noticed a big shift in their liabilities section. Something about long-term trade payables.
Yeah, that's an interesting structural change. At the end of 2024, they had nearly 480 million TL listed as long-term trade payables. Essentially, money owed to suppliers but not due for over a year. By September 2025, that figure dropped to zero.
Zero. What does that imply?
It suggests they've moved away from relying on extended payment terms with their suppliers as a form of long-term financing. Instead, they seem to have shifted almost entirely to formal financial instruments, bank loans, financial leasing to manage their funding needs. Maybe suppliers weren't willing to extend that much credit anymore, or the company chose a more structured approach.
Okay, so debt is way up, reliance on FX loans is high, supplier financing is down. What about the other side of the balance sheet? Equity. Did that grow too?
Yes, the equity base did strengthen, which is important as a buffer against the higher debt. Total equity increased from 3.79 billion TL at the start of the year to 4.24 billion TL. This increase came from two main sources. That 500 million TL bonus share issue we discussed, which reclassified reserves into capital but didn't add new funds, and the 617 million TL net profit recorded for the period, even though much of it was non-cash monetary gain. So liabilities surged, but the equity cushion also grew.
Right. Now let's talk liquidity. Cash. This is where the story seems to get quite concerning, isn't it? The report suggests a major cash crunch.
Concerning is putting it mildly. The combination of heavy investment spending and, as we'll see, pressure on working capital really drained their readily available cash. Cash and cash equivalents on the balance sheet fell off a cliff. They went from 382.4 million TL at the end of 2024 down to just 41.2 million TL by September 2025.
From almost 400 million down to 40 million. They burned through nearly 90% of their cash buffer in 9 months.
That's what the balance sheet shows. And the key liquidity ratios confirm this tightening picture.
Okay, maybe explain those ratios in simple terms for someone managing, say, their household budget. What does the current ratio tell us?
Okay, the current ratio is like looking at your easily accessible savings and upcoming income versus your bills due in the next year. A ratio above 1, ideally closer to 2, means you can comfortably cover your short-term obligations. Kuzey Buru's current ratio dropped from a pretty comfortable 1.87 down to 1.44. Still above 1, so not immediate panic, but definitely tighter. Less wiggle room.
Okay, 1.44 is tighter. What about the quick ratio, the acid test?
The quick ratio is stricter. It's like asking, can I pay my immediate bills without having to sell things I own, just using my cash and the money people owe me right now? It excludes inventory from the assets because selling inventory takes time. Here, the ratio fell from 1.19, which was okay, down to 0.83.
Low 1, so 0.83 means...
It means that based only on their cash and the receivables owed to them, they couldn't cover all their immediate short-term liabilities. They are structurally reliant on selling their existing inventory quickly to generate the cash needed to pay their bills. That's a much more precarious position.
That sounds like walking a tightrope.
Yeah.
Very little room for error if sales slow down or customers delay payments, and the cash ratio.
The cash ratio is the most brutal measure. It's just cash in the bank versus immediate liabilities. That plummeted from 0.21, meaning they had 21 cents in cash for every lira of immediate debt, down to just 0.01.
0.01. That's practically running on fumes in terms of actual cash on hand relative to immediate needs.
It really highlights how tight their cash position became by the end of this period.
Yeah.
They're operating very close to the edge of their liquid resources.
Okay, so the balance sheet shows the cash drain. Where did all that cash actually go? The cash flow statement should tell us that story, right?
Exactly. And the cash flow statement contains perhaps the biggest red flag in the entire report. Let's look at cash flow from operating activities, the cash generated or used by the core day-to-day business of making and selling pipes. It was massively negative. They had a cash outflow from operations of 1.218 billion TL in these 9 months.
Over 1.2 billion lira burned just running the core business. That's way worse than last year, wasn't it?
Far worse. Last year, the outflow was 231.4 million TL, which was already negative, but this is more than 5 times larger. Why such a huge operational cash drain?
Yeah, why? If revenue is still over 3.7 billion, even if down, why are they burning so much cash operationally?
It boils down to working capital. The report indicates enormous increases in both trade receivables, money owed by customers, and inventory, value of unsold pipes and raw materials. Each of these categories increased by over 1.2 billion TL during the period, even after adjusting for inflation.
So wait, over 1.2 billion extra tied up in inventory and another 1.2 billion extra tied up in customers taking longer to pay. That's almost 2.5 billion lira of cash locked up in working capital.
That's the essence of it. It suggests that maybe sales were achieved by offering longer payment terms, or customers are just paying slower. And the huge inventory buildup means they produced a lot more pipes than they sold, or the value of the raw materials they hold has ballooned. Either way, this massive increase in working capital had to be funded somehow, and since operations weren't generating cash, it had to come from borrowing.
So they're borrowing heavily to fund the big CapEx projects, and they're borrowing heavily just to finance the day-to-day gap in operations caused by rising inventory and receivables. That sounds like a very dangerous cycle.
It is a significant cash burden, absolutely. The cash flow statement confirms this picture. Cash flow from investing activities was negative 348.3 million TL, mainly reflecting that CapEx spending, 401.8M on acquisitions offset slightly by other items, and to cover both the 1.2 billion operational cash hole and the 348 million investment outflow, they relied entirely on cash flow from financing activities.
And that was positive.
Strongly positive, yes. It showed a net cash inflow of 1.147 billion TL. This inflow primarily came from new borrowings, which brought in 1.43 billion TL in cash. They also paid out 138.6 million TL in dividends during the period, likely based on the previous year's profits. So the financing inflow basically plugged the massive operational and investment outflows, but it means the overall debt level just keeps climbing.
Okay, let's try to bring all these threads together now in part 5. The big picture, future outlook, and risks. We have this story of huge ambition, massive investment, but also serious financial strain, particularly around cash flow and debt. What's management saying? What's their outlook?
Management's commentary, as you'd expect, focuses firmly on the future potential. They confirm that past targets were generally met and strategic decisions are being implemented. Their optimism is anchored in those global market growth forecasts. We discussed the 4-6% annual growth for plastic pipes and that strong 5.5% CAGR for the higher margin GRP composites. They repeatedly point to global drivers like infrastructure renewal in developed nations and the urbanization boom in emerging markets, particularly Asia-Pacific, the Middle East, and Africa, as the justification for their expansion.
So in their view, the new capacity from Malatya, EGE1, the PPR expansion, this is all about positioning the company to capture a big slice of that future global growth.
Exactly. They see themselves as planting the seeds now, using borrowed capital, yes, but with the expectation of a massive harvest in terms of revenue and profit down the road. From management's perspective, the current financial pressure, the cash crunch, is likely viewed as a necessary temporary cost of executing this transformation into a much larger, more global player.
Okay, that's the long-term vision. But for you, the individual investor considering this now, the immediate risks seem pretty substantial. What are the key sensitivities we need to keep in mind?
You're right, the near-term risks are significant. Firstly, there are clear market risks and macroeconomic sensitivity. We saw the direct impact already with that 50% collapse in export revenue this period. Their performance is highly vulnerable to what happens in global economies and competitor actions. Fluctuations in the US dollar and the euro are also critical, not just because of export pricing, but because a large chunk of their debt is in those currencies. A weaker lira makes that debt burden heavier.
And inflation itself remains a double-edged sword too, doesn't it?
Absolutely. While high inflation creates that helpful non-cash monetary gain on the profit and loss statement, it also drives up their actual costs energy, despite the GES plan maybe not being fully online yet. Labor, logistics, raw materials. If they have to keep raising prices to cover these rising costs, it could hurt their sales volumes even further, especially in competitive international markets.
And perhaps the single biggest risk factor, financially speaking, is that reliance on the TMS-29 accounting mechanism itself.
I think it is. We really can't stress this enough. The healthy-looking reported net income is significantly propped up by that large non-cash monetary gain. That gain is a direct consequence of their net debtor position combined with very high inflation. It's currently doing the heavy lifting, masking the weak operational cash flow and the ballooning finance costs.
So the nightmare scenario is a sudden drop in Turkish inflation.
Precisely. If inflation were to fall sharply, that monetary gain would shrink dramatically, or could even reverse into a monetary loss if they somehow shifted to a net monetary asset position, which seems unlikely given the debt. If that happens, the buffer disappears. Suddenly, the full weight of those 508 million TL in financing costs, combined with the already reduced operating profit, would hit the bottom line directly.
And that could plunge the company into a massive reported net loss, even if their underlying business of selling pipes didn't change overnight.
That is the core vulnerability. The reported profit figure right now potentially gives a misleading sense of security. It hides a severe underlying cash flow challenge. They are effectively using high inflation as a temporary shield for their profitability while they leverage up aggressively to build for future growth. It's a high-wire act.
It really creates a fascinating and maybe quite risky situation for investors.
Yeah.
Kuzey seems to be telling two very different stories at the same time.
That's a great way to put it. Two parallel narratives. On one hand, you have the future is bright story. They're executing what looks like a classic growth playbook. Huge targeted investments, especially in high-margin GRP, strategic move towards energy independence with the solar plant, serious R&D investment in AI and proprietary materials to build a tech advantage, and impressively, maintaining or even improving gross margins despite challenges. That's the blueprint for becoming a much bigger, stronger company in, say, 5 years.
That's the bull case. But then there's the other story, the reality check playing out right now.
Exactly. The immediate financial picture is stressed. A shocking 50% collapse in export revenues this period. Liquidity is under severe pressure, cash reserves almost gone, the quick ratio falling below 1, meaning they rely on selling inventory to pay immediate bills. And maybe most worrying of all, that massive sustained negative cash flow from core operations, forcing them to pile on more high-interest debt just to fund their day-to-day working capital needs.
So for you, the individual investor looking at this, the decision really boils down to your time horizon and your tolerance for risk, doesn't it?
It really does. Do you believe in the long-term strategic vision? Do you think those investments, like the projected $40 million extra revenue from the Malatya GRP expansion, will eventually pay off handsomely? Or are you more concerned about the immediate financial fragility, the huge working capital drain, the reliance on that non-cash accounting gain to report a profit, the risk that they can't convert potential into actual cash flow fast enough before the debt burden becomes overwhelming?
It comes down to conviction. Do you believe management can navigate this cash crunch and successfully turn all that new capacity into profitable, cash-generating sales and do it quickly?
That's the multi-billion lira question, isn't it? They need to start generating positive operational cash flow and soon, especially if the inflationary environment changes and that monetary gain shrinks or disappears. And that really is the deep dive into Kuzey Age 9-month 2025 results.
A complex picture indeed. Thanks for walking us through that. And thanks to you for joining us on the Deep Dive. We'll catch you next time.